What is going on, guys? Welcome back to the MG YouTube channel. I want to talk to you guys quickly about stock market investing, and it's going to be slightly advanced, but this will also give some premise of like some other stock market things as well. So there'll be some like beginner level stuff, but this is really targeted towards options and also towards like hedging on your portfolio. So I have a very interesting thing that I'm doing, and I also just made another video where I went deeper into like Tesla, Robotaxi, Lyft, Uber, and how the disruption of robotaxi might affect companies like Uber and Lyft, and how I pretty much guarantee they're going to affect Uber and Lyft. So go watch that video if you want to see about that. Now I'm going to use those same things in this example. So if you watch that video, then watch this video. It might give a little bit more context. But the main thing I want to target in this video is about hedging on your portfolio. So hedging means to basically protect yourself from any downside risk in the stock market, and also to potentially take profit on the downside of your portfolio. So it's inevitable that the stock market is going to go down at some point in time. It always goes up and it always goes down. It always goes up and it always goes down. And sometimes it goes down significantly. We just, back in May, like half the stocks went down like more than 20%. I mean, I bought some of my stocks at like 30, 40% off, basically a discount. At that point in time, I really wasn't doing too many hedges on my portfolio, and I just started doing a hedge, and I think this hedge is going to be like extremely profitable. I'm still just playing around with exactly what options that I want to trade. And so for anybody who doesn't know what options are, let's just say options are kind of like bets that a stock will be a certain price at a certain date. So they have what's called expiration dates. Those expiration dates are, different dates out into the future. So a lot of your popular stocks will have expiration dates, like one for every month. They'll have, and then as you get further out, like a year, 2 years out, they'll have them for like every 6 months to every 1 year. So like you might be able to get like a, June 2026 option, and a December 2026 option, and a January 2027 option. And then it might go like all the way up to 2028, like a January 2028 option, as far as like how they stagger out. Now that could be with calls and with puts. So a call is basically a bet that the stock is going to go up in price. A put is basically saying that the stock is going to go down in price. So my hedges that I'm doing right now are puts. And the reason why I'm doing these puts is for two reasons. First of all, to discuss on the hedge side of things, I am utilizing these puts as a hedge. So if the stock market goes down in price, that I can then, my portfolio won't take as much of a hit, but then ultimately I'm going to take profit on those. After they go down a certain amount, then I'll go ahead and take profit. Also, if it's a significant enough move down in a particular day, I'll take profit. So I'm actually like utilizing them as a bit of a trader as well. When I say a trader, for example, like literally I opened up today, and this is why I made this video. I'm pulling up my phone real quick so I can look at some actual data. So I'm pulling up my Robinhood right here. And so the stock market is down like quite a bit at the open of the market. Tesla was down as much as 4% at some given time. So while Tesla went down, I bought some more Tesla call options. And then yesterday I was actually buying Lyft and Uber puts. Now today I'm actually selling out of some of my Lyft and Uber puts because I have Lyft down at 1% right now. Was down as much as 2.79%. That's on the stock. That's not even on the options contracts. Let's go to Uber. Uber got down to as much as 1.48% down. Currently only down 0.39. So the market's starting to bounce back. So we might have a green day here shortly. It looks like a pretty strong bounce back. So I think we'll go green again today. Tesla's actually still not recovering. They're still down 3% for the day. Now I'm starting to see some recovery. I might actually go ahead and place a position, a call trade. I'm just like skeptical on like if this is going to be if it's actually going to continue to rally higher or if it's going to dip off. I might wait for us to get to a lower percentage. By the way, it's kind of a different topic, but I might wait for Tesla to get to be down like 3% mark, maybe even like 2.7% down, to just kind of indicate a little bit better that we're going to recover for the day. But then again, I might not. a lot of my trades and the way that I'm trading right now is I want some cash available. So I'm trying to keep like 10 to like 20% of my cash available. One, I have some property things that I'm going to be doing. So I need that. I'll need some cash for that. And I don't want to have to deal with like my stock market account being down and have to pull money out of that, out of the stock market account for the properties. But I also want to keep my properties money active in my portfolio as well. So, and then this comes in with part of the hedge. So to give you some examples, I'm going to go into some of my Uber puts here. So my Uber puts are currently down 1% right now. No, sorry, they're up 1%. Because since Uber is down, my puts are up. So my puts up 1%, but they went up as high as, hold on, this is a little bit hard to navigate sometimes. They went up as high as 9.43% today. So if Uber continues to trade down, then it'll go even higher than that 9-something%. We'll get down to 10% down, whatever. And some of these positions that I have like for lift, I'm trying to hold them for the long term. But when I have an immediate, like I just bought these options yesterday and I get a 10% gain the next day, I'm going to take that 10% profit. There's supposed to be a longer term hedge. So if like if the market starts going down over time, but anytime I see big moves in the market, I try to like capitalize on that. If I see like a 5% move down on the market, 3, 4, like especially if it's immediate fall off, I want to try to sell at least portions of that. I'll sell in staggers as we go down. So like I only have 2 contracts of that Uber position of that put. And again, these are supposed to be long-term holds, but I'll stagger sell those. So like I might sell one at, I'll just say in percentages so it's easier. I might sell one of those at like maybe 8% profit, and then I might sell another one of those at a maybe 15% profit if it goes down to that today. And sometimes I like to leave some open too. Now with Uber, it's a smaller position with only a couple option contracts there for that particular option. Sometimes I'll leave some open in case it just like plummets, right? Because I don't want it to, like, if it gets down to where it's like 50% down for the day, I don't want to like sell at like 10 or 15%. I'll take some profits at 10 and 15%, but then I might let it just plummet to like 20, 25, 30 percent in a singular day. So like to give an example on I actually even have Tesla puts, but I'll get into those in here in a second. So my Tesla calls are down almost 8% today. So like now I'm buying in on those Tesla calls, and they were down as much as 10% today. So I was kind of trying to buy as much as I could down there they got down to like 53, and I bought some at 53. I think I bought like 2. Let me just check my history. I'll be able to view all history. So I bought at 53, 53, 53.5, and that's all I bought today. So I bought 3 contracts today. And when I say 53, it's like 5,300 is the total price, but the contract price is 53 and then times 100. But these same contracts, to give you perspective, again, we're down 10% today. We were down at 10%, and I was basically buying in at that very bottom right there. I really liked that 53 price for what we've been trading at for the past week. Now we're actually climbing up to 55, which that alone is 2.5% return on those contracts that I just bought like minutes ago. So like 2.5% in a day, like you as a trader, like I'm not much of a trader, but as a trader, that's significantly good. Like 2.5% in a singular day. If you just said I only traded for 10 days out of the year, you just literally are making 20% a year in returns, which is much better than most hedge funds and stuff. So that's why I like to independently trade. I'm going back on a week looking chart for my contracts. So my contracts were at 60. And also when you're looking at like Robinhood and stuff like that, sometimes it doesn't read appropriately. Like this is one thing that's very important about staying on top of your stocks. But like it's showing an all-time high of like 60 for these option contracts. But I know for a fact that these option contracts sold for like 61 and 62. I have it in my history that I sold some at 61 and 62 per contract. But it's kind of like an average high for the day is the way that it looks at. So when you're looking back at like the history, I'll try to show this real quick. Zoom in. Okay, no. When you look back at that history there, it's kind of like rounded numbers, so it doesn't show you exact true history. So again, they were trading at 60. So whenever they fell back down to 53, to me that's a very good buy. Like anywhere below like 54, 53, 52, I'm gonna start buying in trickles in that, and then like then I might space them out like 51, 50, and I'll kind of see how the market plays. Now, if they went to like 53 and kind of rode 53 for a longer period of time, I would cancel some of my other contract purchases for like 50 and 51 and try to buy into at the 53 mark if I could. But I'm trying to be a little bit more conservative in like my earnings and stuff like that, and not take as much risk as far as I want to have cash available. But to go back into kind of like the hedge side of things, I want to go back into like some of the I also tried to buy some AMD calls as well. I don't know if they went through. I have a lot of things active. So a lot of times I'll put in stuff and I'll put them in at like ridiculous prices where I'm probably not going to get them. But if I do, like if there's a spike in the market, like we had even if it jumps down for 1 second where we drop like 10%, some of my stuff will buy in. And then basically if it bounces right back, I can immediately have like a 5-10% return. So like I want into them AMD positions. If I don't get into them, oh well. But I do need to build out like my AMD position a little bit more. But I'm pretty much fully on Tesla. Going back to my hedges though, okay. So like my Lyft and Uber puts, it's really all I'm gonna talk about right now, okay. My Lyft and my Uber puts are a hedge against the market coming down like it did today. And also, I believe that Tesla is going to disrupt their business. So I think that once robotaxi really expands and starts to capture a lot of revenue, it's going to capture a lot of market share and revenue from Uber and Lyft, and their numbers are going to start looking bad. So my projection on that, without you having to go back and watch that other video, is that by the end of this year, physical robotaxis will be in enough spaces and enough volume to disrupt robotaxi or disrupt Lyft and Uber. By Q2 of 2026, I believe you'll start to see revenue impacts from robotaxi on Uber and Lyft. And so when you start seeing those revenue impacts, that's going to drop the stock. First of all, just robotaxis being on the road could drop the stock. But once it shows up in the numbers that it's actually having an impact on the revenues, it's going to make the stock plummet. And then also, if there's, what do you call it? Not proof. What do you call it? Oh my gosh. Sentiment. That was what I was looking for. If there's sentiment in the market that that robotaxi is going to take over Lyft and Uber and destroy them, basically the stock will go to like under 50% overnight. As soon as the market definitively feels like, oh, they're about to like take their market share, they're like about to take it all because they offer robotaxi at a lower price. And why would you take a $20 ride when you can take like a $10 ride? Like people choose between Uber and Lyft based on like fucking $2. So for you to have Uber and Tesla, and they're at 50% difference, you're hands down going to choose Tesla. And on top of that, people are choosing the option of Waymo through like Uber. Like you can rent or get a Waymo through Uber and through Lyft now. And people are literally choosing the autonomous vehicle and paying extra for the autonomous vehicle. They're paying more for the autonomous vehicle than they are a human because they just don't want to deal with a human driver picking them up. They're choosing the autonomous vehicle option and paying a premium to do it. So if not only is your Uber price here, but they're paying a premium to get the autonomous here, but Tesla has autonomous down here, it's just completely disruptive. Completely disruptive. Just price alone, even if they do like an 80% price cut, they're going to disrupt their market share. So even if we don't see huge revenue spikes from Tesla for some period of time due to robotaxi, I think we'll see deductions in revenue spikes from Uber and Lyft way before that. And I think just if the sentiment switches, like oh shit, like where we see or when we see like that sentiment shift of like, oh shoot, like they're messing them up, it's going to plummet. So I have this hedge against the market that is, in my opinion, it's a double-edged sword, meaning that it protects me if the market just goes down in general, and it also has the potential to make an extreme amount of upside if Tesla's to disrupt Uber. So everything that I do, I like to have utility in it, and I like to have double utility. So, like for example, I'm making this YouTube video. I'm making this YouTube video because I was, doing some of my stock market trading stuff, and I was analyzing some stocks, and some of these thoughts were coming to my mind and stuff, and so I decided to make this video and share like this hedge and like how I'm like super bullish on this hedge, and I'm going to keep kind of like building out a bigger position. I might even go as far as to have like 10% of my portfolio in this hedge. Why would I put so much of my portfolio in this hedge? Well, it's because of that double-edged sword. One, it's protection on the market going down, and two, it's a bet against robotaxi disrupting Uber and Lyft, and then I'm also hedging my hedge by choosing Uber and Lyft. So instead of just choosing one and saying I'm going all in on Uber going down, or I'm going all in on Lyft going down, I'm hedging that by basically betting against both of them. Now, it wouldn't make sense to bet against like Waymo and try to put a put against Waymo, because Waymo is owned by Google. So if you're to put a put against Waymo, you have to put a put against Google, and I'm not putting a put against Google. The big thing with Uber and Lyft is that is their revenue. Ride sharing is their revenue. If they don't have ride sharing, they don't have revenue. Uber has, their freight side of their company, and I think they're going to try to build that out. I think they know they have to start building that out pretty significantly because they know what's coming with robotaxi. Lyft, I don't know that has anything at all. Maybe food delivery or something like that, but like food delivery is not that big of a deal. People act like you don't even need a robot for food delivery. Like, people don't mind walking out to the street to go pick up their food. People don't want to drive 20 minutes across town to go get their food. Not maybe it's raining, whatever. Somebody might have that complaint, like I don't want to go out in the rain. I don't want to walk from my house to the street to grab my food. But yeah, I mean, you think it's difficult to have McDonald's take a bag of food out to an autonomous vehicle and sit the food down? No, they already do order delivery. They already do curbside delivery. It's not that big of a deal. The car will just sit there. There just won't be a human, and then they'll tap a button that says, "Okay, I put the food in the car. Doop, done." The car will drive off. You know what I mean? Like, there's vehicles like Teslas that have a heated seat. You can put the hot food in the heated seat. Boop. Now it has a seat warmer, which I think that Tesla and or another company needs to like outfit Teslas and stuff like that to be. I think Tesla should do it. But should be like food delivery vehicles where they have like heaters built into them, like super well insulated, and you can put food in them. But that's something else I've talked about on other videos and stuff. I don't want to get on those side tangents because we'll do an hour-long video. But yeah, so I have this double-edged sword. Market went down today. Really had nothing to do with Tesla's disruption, but able to take some profits on Uber and Lyft due to some just market corrections of the day. And one of the easiest ways that I know that is I go look at my stock list, both my watching and the stocks that I own, and I just see it. If they're all red, the market's down for today. You know what I mean? This is a market issue. This is nothing to do with Uber and Lyft and blah, blah, blah. And so therefore I pretty immediately go ahead and take a sell. Maybe I'll do some quick research on why the market's falling if I don't already know why it's falling. But sometimes I know why the market's falling, and other times I don't know why the market's falling. So I need to do some quick research to see if it's a huge catalyst or if it's nothing really, and like the market's just panicking and selling out for no reason. I love it when the market sells out for no reason, or even is overbought for no reason. Even when Tesla's going up, and I'm like, I'll hurry up and search. I'm like, why is Tesla going up right now? Is there any news? And I'll scan for news and stuff like that. If I don't see any news, I generally start selling my positions. Now, if the news comes back and it's something like Tesla just launched robotaxi in Dallas, I'm like, oh, okay, that's a big deal. this makes sense. This run might not be a today run. This run might be a throughout today and tomorrow run, and maybe even into next week run. Because when you get these bullish catalysts and these potential revenue generation things and expansion and proof of this potential revenue generating machine, the stock price will go up. That confidence and that sentiment will continue to go up. On the flip side, I am holding some Tesla puts, but especially like when Uber and Lyft are having good days. Like if you have Uber, Lyft, and Tesla all having good days, and let's say for instance they're all up the same amount of percentage, there's no reason for me to put a put on Tesla as my hedge for the market going down when I could put my hedge on Lyft and Uber that I think they're going to go down in a good market at some point here in the next like 6 months. 3 to 6 months, Tesla or Lyft and Uber are going to start going down in market value due to robotaxi. Not even nothing to do with, not even nothing to do with the market itself. But on the flip side, when the market has down days like today, I'm going to sell some of my positions. Again, I'm still playing around with what options I want to get and whatnot, because like with options, especially like a lot of other options, they sell slow, and that's one thing I really don't like. And so I'm trying to figure out which options like have more activity, so that way like on a day like today, they could be up a high percentage, but if people are not really buying a lot of volume of them, it becomes hard to sell them, or you have to sell them like way lower than like what the actual up percentage is. It's just kind of a funny thing with options. There's a lot of learning to going on with those options, and I can make some more videos on that. Again, I'm still like researching the Uber and Lyft options. I won't even say that I have like a perfect set of options. There's a couple of them that I am liking as of right now. Like I have an 87.5 option. What is it? 87.5. Yeah, so 87.5 put, and then I have a 32.5 put. So like the 32.5 put, it's pretty far out. It's 2027. So it's a super safe option. It was relatively cheap option. But there's not a lot of movement right now because its expiration is so far out. So that's another thing to think about, is like I got this option that's really far out, but it doesn't really follow the market very well because there's not a lot of volume in it, and it's so far out that people are not really that interested to trade it. Whereas like Tesla has so much volume in it just due to the stock. The stock is probably one of the highest volume traded stocks in the entire stock market, which then pours over into like the options. Then the options are like one of the highest, bought and sold options in the stock market. I have a Lyft 12, I have a Lyft 10, a Lyft 8, a Lyft 5. And like some of these, like my Lyft 5 is like a Hail Mary. My Lyft, when I say 5, I'm saying like that's the dollar amount, that's the strike price. So my Lyft 5 is like literally spent pennies for it. Nobody buying it. I'm okay to lose every dollar I have in it. However, if this Lyft put becomes active again, it can be worth thousands of percents of gains. Thousands of percents overnight, boom, thousands of percent gains. But again, it has to become active. I don't love the 5 put. I really want to get like another, like this 8 or 10 or something like that, because I think Lyft is at like 20 something, 22 a share right now. What is it at? 20. Lyft. Where you at, dude? 21. Okay, so yeah, it's 22, almost 22 right now a share. Okay, so at like $10, that's only a 50% reduction. It's not even like that bad. I mean, you have market corrections that are bad, and stocks drop 20, 30, 40% anyway. That has nothing to do with like the fundamentals of the business. So, even a put like one of these could become extremely active just due to having a huge market crash. If you have a huge market crash on top of Tesla, messing with this, 50% is nothing. I mean, they can even go as low as 75%. With those two catalysts working together at some point in time. So with that being said, then that 5 put is actually not bad. That Lyft 5 strike, not bad. My biggest fear with the Lyft 5 is that somebody buys them, that they get that low in value, that Uber decides they're going to buy them so that way they can have their market share. Tesla decides they're going to buy them so that way they can have their market share. They can have their consumer base. They'll basically shut down the app and just take all the users. They'll just put Tesla only vehicles on it probably and start phasing out independent drivers, and or they'll have it as a hedge against like maybe rainy days. So like whenever it's raining and some reason like robotaxi can't work, it works well in the rain, but there's gonna be conditions where, as of right now, it doesn't work extremely well. Like in snowy conditions, it just may not function at the same safety level that it functioned at in clear roads. You know what I mean? So it might still be functional, still might get from point A to point B, but then like the accident rate might spike. I mean, same thing happens with humans. Like as soon as we have like bad rain and bad snow and all that good stuff, like wrecks start to go through the roof. You start seeing people off in ditches and all that good stuff. So like they may not want that liability during those type of conditions. So maybe they'll use like human drivers to maybe accommodate. Maybe they'll use human drivers with Teslas, so they'll have like supervised rides on like the bad weather days, and maybe they have to spike up their the fees that they charge during those instances just due to the extra risk that they have to take on, and or having a driver in the car. But that's like a whole other topic again. The important thing is that Lyft might get bought by somebody before it hits $5, and then that would screw up my whole put. I actually traded something. It's just, and I'm just testing around with options. But I did one option, and it was down a lot in its price, and so like I bought into it, and then like 2 days later it came out with information that they were acquired. I'm like, you gotta be shitting me. And so like, say for example, like my strike price was like $13, and they were getting bought at like $14 a share. And so like, you'll never hit that strike price because of that they're being acquired by at $14. So like, there's no reason for the stock to ever drop below $14 unless somehow you had a market crash, and then like the algorithms just sold that stock, not knowing that like it's like guaranteed win. Like it may not have had that like characteristic baked in there that like this should never go below this price. But yeah, this is also why I'm playing around and I'm trading money, and I'm losing hundreds of dollars. Not in the grand scheme of things, but like in a day I could lose hundreds of dollars on testing and trying, because when I go, that cost me $500, or that cost me $200, or whatever it is. It's a learning experience. Like that exact example I just gave of, I bought this thing with a strike price of 13, it got acquired by 14. Now that thought's in my mind for Lyft, and I'm like, like I could go all in on that because I feel confident about that price. But if somebody buys Lyft, it screws up the whole thing. So then that's why you have to diversify your hedges. So like, okay, this one's an extremely good one as far as like I'm paying nothing for it basically. And the upside could be thousands of percent. However, if it comes in and gets bought, it's useless. You know what I mean? So then, then to have some diversification in that, to have different stagger points where some of them are not going to get those incredible gains. Some might only be a 2x gain, or, maybe a 4x gain, still really good, but have much less risk and pretty much zero potential of being like bought out, let's say. Because my perspective is Tesla, Uber, none of these people are going to start buying one of these other companies until that major downside starts to happen, especially Tesla. Tesla's not going to buy in until they've pretty much smacked them in the face, and then their stock price is just so low. There's like, I might as well buy them. It's like a quick couple $1 billion, you know what I mean? And it's like nothing to them. Like, I might as well. I mean, we really don't need them, but like, we got money like that. Let's just do it, That's how they can handle the situation. So let me know if you like kind of doing this little dive on these options. I could do screen share stuff. It just makes it complicated. Then I have to get my editors involved, and they already have enough things to do. They already tell me that I give them too much work to do. So, yeah, it's it's a lot easier for me to just do these point and shoot videos. But again, if there's any particular videos that you'd like to see, particular types, or yeah, if there's anything else I can share with you with these options and some of the different like trades and stuff that I'm doing. Also, we talk about some different investment stuff. As soon as I started seeing like interest on like what people want to know about, like with our properties or with, you know, stocks or Tesla or whatever it may be, those are some of the topics that I'm talking about. I also talk automation stuff on our Elite Automation YouTube channel, but that's like automation and manufacturing specific stuff. But yeah, check it out over there if you want. Subscribe if you stayed around this till the end here, and we'll catch you on the next one. Peace.